If last week felt intense, what happened overnight should make you cautious. Silver didn't climb, it jolted. And when a market that usually breathes suddenly spasms, the right reaction isn't excitement, it's restraint. Because sharp moves aren't random, they're responses to stress. It's Monday, January 26th, early morning in New York. And what just played out in silver wasn't a textbook rally, it was a structural break to the upside. The kind of move where the chart looks rushed, like time itself compressed. That doesn't come from confidence, it comes from pressure giving way. There's a stress indicator behind this move that most people never bother to track. It isn't price by itself. It's how location, contracts, and timing stop agreeing with each other. When those relationships fracture, markets don't adjust gradually, they snap. But before we jump ahead, the order of events matters. Earlier in the session, silver was grinding higher, controlled, predictable. Buyers were present, but nobody was desperate. It looked like standard accumulation. Then, late in the day, the tone shifted. What had been orderly turned aggressive. Silver cleared resistance levels that had capped it repeatedly, and instead of slowing down, it surged. That surge is the clue. Gradual advances are normal. Late session vertical moves are not. Those are where pressure shows itself. Stops get triggered, shorts scramble, options hedging kicks into high gear, and that last piece is often underestimated. When traders load up on upside options, the dealers writing those contracts have to hedge. As price rises, hedging demand increases, that buying pushes price higher, forcing even more hedging. A self-reinforcing loop. Price moves, hedging reacts, price moves faster. That's how a calm market suddenly looks disorderly. Now add silver's Achilles heel, liquidity. Silver doesn't need massive inflows to move violently when participation thins out. A handful of large players hitting the same side can make it look like something broke, even if what really happened is sellers stepped away. Then there's positioning. Silver has always been a favorite playground for shorts. It's volatile, it's industrial. In slow markets, that works. In fast markets, it backfires. Stops trigger, margins get stressed, and trades turn into emergencies. But here's the part people forget. These mechanics don't just push price higher, and they reverse just as abruptly. Margin requirements rise, risk limits tighten. Liquidity returns on the other side, and when forced buying dries up, gravity reasserts itself. That's why this kind of move is dangerous. It feels powerful because it's mechanical, and mechanical moves rarely unwind gently. So if this looks easy, take a breath. Silver has a long record of rewarding confidence right before punishing it. It did it during legendary squeezes decades ago. It did it again when speculation and fear collided more recently, and it can do it again anytime liquidity disappears. The upside is real. So is the risk. The difference comes down to discipline. And silver wasn't acting alone. Gold wasn't quietly tagging along. Gold was leading. Recent action pushed it into fresh record territory above 5,000 an ounce, while silver blasted through the 100 level without hesitation. When gold turns aggressive, it drags the entire metals complex with it. That matters because gold shifts behavior. People who never pay attention to silver suddenly do. They look for exposure, leverage, alternatives. The logic doesn't have to be perfect. Markets move on stories. And here's what often gets missed. When gold and silver move together, it's rarely just about metals. It's about confidence, or the lack of it. Gold reacts first when institutional anxiety appears. Silver reacts when that anxiety turns emotional. Gold is mass, silver is velocity. When both accelerate simultaneously, the market is usually pricing in currency stress, policy uncertainty, and an expectation that liquidity conditions will loosen. Capital flows confirm it. Physically backed gold funds have seen massive inflows, pushing holdings to record levels. That's not noise, that's allocation. And allocation doesn't flip overnight. Central banks reinforce that signal. Public reserve data continues to show steady buying, particularly from countries reducing reliance on a single monetary system. Those buyers aren't trading headlines. They're repositioning for years ahead. So when gold moves like this, it's telling you something foundational is shifting. Silver just expresses that shift more violently. Now let's break down the chart without jargon. First, a steady rise, then a sharp late surge, then continuation after most people mentally checked out. On top of that, something more revealing happened. Overseas pricing didn't simply follow, it exceeded. Another major market printed higher prices, meaning silver wasn't valued the same everywhere at the same time. While New York was surging, Shanghai was effectively saying, "Here, it costs more." And the gap wasn't minor. At times it reached double digits. That's not speculation. That's friction. People love to simplify arbitrage. Ship metal, pocket the spread. Reality is far messier. Different contract standards, approved refiners, purity requirements, delivery mismatches, financing costs that spike with volatility, taxes and regulatory drag. So no, a premium doesn't mean silver vanished overnight. But persistent premiums do mean the system isn't flowing freely. Metal might exist, just not where it's needed. in the form it's needed at the moment it's needed. And sometimes intermediaries step back entirely because the risk outweighs the reward. That's how fragmentation forms. The global market stops behaving like one unified pool and starts acting like separate basins. When that happens, markets don't negotiate. They force alignment. Now to the part that frustrates regular buyers. The number on a screen versus physical reality. You can see spot instantly. But try to buy real metal in size, and the experience can be very different. Try to sell, and it can feel worse. Some dealers are discounting certain items because their cash is tied up. Others are charging extreme premiums because they don't want to sell metal they can easily replace. This isn't just opportunism. Behind the scenes, refining becomes the bottleneck. When volatility spikes, all forms of metal flood in. Scrap, mixed bars, odd formats. Refiners get selective. High purity material moves first. Everything else slows. Suddenly, not all silver is equal. That's where chaos comes from. One shop is overstocked and defensive. Another is empty and aggressive. Another won't quote at all. And chaos is expensive. Dealers survive on liquidity and turnover. In calm markets, hedging is routine. In fast markets, every decision carries risk. Buy too much, get trapped. Sell too much, get stranded. So spreads widen, access narrows. That is why two people in the same city can have completely different experiences on the same day. And it's why screen prices can be misleading. Physical metal is a supply chain. Supply chains charge premiums when demand hits all at once. So here's the unglamorous advice. This is not the moment for emotional buying or selling. When spreads blow out, you're paying a volatility toll. If you already hold physical for long-term reasons, one violent session doesn't change that. If you don't hold it and you're chasing a vertical move, you're likely paying for someone else's exit. Could silver continue higher? Yes. Markets can stay disorderly longer than people stay disciplined. But trends never move in straight lines. Spikes invite shakeouts. Confidence invites reversals. The real question isn't upside, it's survival. Now, what's driving this? First pressure point, policy. Silver is increasingly viewed as strategic. Procurement behaves differently than investment. It prioritizes certainty, not price. Second pressure point, export friction. China has signaled tighter oversight of outbound material flows. Even licensing creates delays. Delays encourage hoarding. Hoarding creates premiums. Third pressure point, structural demand. Silver sits at the center of modern infrastructure. Solar, electrification, electronics. Industrial demand is running at record levels. Solar alone consumes enormous volumes annually. Add vehicles, charging systems, grids, and data centers, and demand looks nothing like past cycles. Supply doesn't respond quickly. Much of silver is a byproduct. Mines don't scale overnight. Recycling helps, but refining capacity limits supply. During fast markets, processing becomes the choke point. Recent inventory data shows meaningful drawdowns from recent highs. The totals may still look large, but direction matters. Production growth remains sluggish. Deficits draw down inventories. Inventories don't refill on command. Eventually, markets respond the only way they can. They reprice, sometimes smoothly, sometimes violently. And that leads to the quiet shift now underway. For years, buyers focused on price. Now a different question is taking over. Will it be available when it's needed? At the beginning of every stress cycle, markets act polite. Quotes are tight, trades clear, delivery is assumed. Everyone behaves as if supply is a background detail. Then a quiet shift occurs. Participants stop focusing on price and start focusing on access. When that happens, price stops moving in lines and starts moving in jumps. Hesitation gets punished, not rewarded. But before this turns into a one-way fantasy, restraint matters. Because this is where emotionally satisfying narratives tend to replace reality. The popular claim right now is simple. Paper is broken, physical is scarce, therefore collapse is inevitable. It feels convincing. It's also incomplete. Paper markets are designed to bend before they break. Margin requirements adjust. Settlement terms evolve, or rulebooks expand. As long as participation continues, the system can function under far more stress than most expect. At the same time, retail shortages can appear dramatic while institutional flows quietly continue behind closed doors. So yes, stress exists, imbalances exist, but timing is merciless. Being correct without patience often produces the same outcome as being wrong, which leads to the real question: how do you engage without becoming collateral damage? Start by separating the tools. Paper exposure comes first. Futures and large liquid vehicles offer speed and precision. You can enter and exit efficiently, but they also expose you to sudden violence. Silver does not ease into volatility, it accelerates. If you operate here, you must decide in advance how much pain you're willing to accept. Position sizing, exits, and invalidation points aren't optional. They're survival tools. Now physical. Physical metal isn't about intraday movement, it's about infrastructure, fabrication capacity, transportation, inventory location. When demand surges, friction shows up as premiums. That doesn't mean the metal is wrong. It means emotion has entered the supply chain. The correct response isn't urgency, it's patience. Let premiums expand and contract naturally. Don't anchor decisions to panic. Will the next session extend the move? Possibly. Momentum often carries, but momentum also exhausts quietly before it reverses violently. That's why the open matters. The open reveals whether demand is being absorbed or whether it's already spent. Now shift lanes. When metals heat up, experienced capital doesn't stop at bullion. It looks at producers. Mining equities aren't protection, they're amplification. They come with operational risk, jurisdictional risk, cost risk, and management risk. But what they offer is leverage through margins. Here's why that matters. A miner's earnings don't scale evenly with price. They scale through spread. If it costs 30 to produce an ounce and silver sells for 40, the margin is 10. Push silver to 80, and that margin becomes 50 without increasing output. That's why quality producers can reprice sharply even if the metal pauses. But this leverage cuts both ways. Not every company labeled silver actually produces silver. Some are developers waiting on permits. Some are explorers surviving on dilution. Some are stories that run hot until liquidity dries up. So selection matters more than enthusiasm. Is the company producing today or always about to? Is cash flow real or manufactured through financing? Is debt manageable if prices pull back? Are costs stable or one energy shock away from erosion? Does management behave like owners or marketers? Ignore those questions and the market will answer them for you, harshly. Another trap, purity. Many silver miners are polymetal operations. That can stabilize revenue, but it also dilutes silver exposure. If you expect silver torque and get copper or zinc sensitivity instead, expectations break down. Watch dilution closely. Bull markets reward capital raises. Sometimes they build value. Often they preserve weak structures. Look at long-term share counts, not just headlines. Energy deserves special attention. Mining consumes fuel and power. Rising energy costs can compress margins even as metal prices rise. Strong operators anticipate this. Weak ones absorb it. Mining stocks can outperform dramatically, or underperform spectacularly, depending on discipline. Recent reports already highlight this divergence. Some producers are generating meaningful free cash flow. Others remain fragile despite favorable pricing. Volatility widens that gap. Now zoom out again. Global silver data continues to show structural deficits. Demand has exceeded supply for multiple consecutive years. Industrial consumption, particularly from solar, electronics, and electrification, remains persistent. Investment demand ebbs and flows. Industrial demand doesn't. Deficits draw down above-ground inventories. Those inventories are often assumed to be elastic. But as prices rise, selling behavior changes. The easiest sellers exit first. What remains are holders who don't need to sell. That's when friction appears. That's when premiums widen. That's when paper prices diverge from physical reality. Now consider sentiment, the most dangerous variable. Silver transitions from neglected to obsessed faster than most assets. When that happens, it punishes everyone who mistakes excitement for safety. Late buyers often learn the hardest lessons. That doesn't invalidate the broader trend. It simply introduces violent corrections. So structure matters. Long-term physical holders, ignore noise. Paper traders, define risk ruthlessly. Mining investors, choose businesses, not symbols. Now the macro signal. Gold at elevated levels isn't random. Gold reflects confidence, or lack of it, in currency systems and policy stability. When gold moves decisively, silver often follows with greater volatility because of its size and liquidity. Watch the gold to silver ratio. Rapid compression suggests acceleration. Sometimes that continues. Sometimes it marks overextension. So what's next? Do premiums remain elevated or normalize? Does near-term supply stay tight or loosen? Do miners report expanding margins or shrinking ones? Do we see a sharp reset or a slow grind higher? Each outcome reshapes positioning. Here's the core takeaway. This move in silver isn't just about price, it's about transition. A shift into a regime where access, delivery, and industrial urgency matter as much as macro narratives. That doesn't promise smooth gains, it guarantees instability. Some days, silver will feel invincible. Other days, it will feel broken. Neither feeling should dictate decisions. Don't anchor to a candle. Anchor to process. Watch spreads, watch inventories, watch behavior, especially your own. That's how you stay standing while others get shaken out.